Hello and welcome again. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is May 17th. It's a Tuesday of 2022 and markets are moving, and we're going to tell you why. Thanks for watching. So right out of the gate, we want to start with earnings season. We want to do a recap. And if you look at the earnings season broadly, we've got some really good numbers from corporations. Corporations obviously are citing inflation. In fact, let's go to the board here. 85% of the corporations that reported in the S&P 500 cited inflation as a concern or obviously impacting revenues. Now, the question is, are they making money? Are corporations earning money? And at the end of the day, when markets are selling off and we're essentially going through a drawdown of 5, 10, 15, even 20%, right now, we're in bear market territory of a technical correction by 20% across several of the indices. So we are technically in a bear market, but when you're a bear market, the playbook is, hey, listen, are earnings coming down? Are revisions coming down? Or corporations able to make money? Now, they're citing in the future concerns, right? They're saying, hey, listen, we've got higher input costs, supply chain, wage inflation, so on and so forth, all materials and even shutdowns in China right now. So that's going to impact, depending upon what the sector, what the company is, management teams to have the ability to have either a positive or above trend growth rate. But let's see where the growth rate is right now for S&P earnings right now. So out of the companies that have reported, again, we're at the tail end of earnings season. So we've got a good broad stroke of a good healthy understanding of the S&P 500, sort of the feeling and the flavor of earnings season right now. Well, 78%, almost 80% have topped their earnings estimates, meaning coming in above line. And we have above trend growth of about 11% on all the S&P 500 companies, and 90% of those companies that reported have grown their revenue. Now, Robert, how is that even possible? We're seeing the word recession. Is recession on the horizon? Well, we just got a first quarter GDP print, and that was negative. We have 2 quarters of that. That technically would be a recession, and all signs right now are pointing to it's still a possibility, but potentially not this year. That doesn't mean it can't if inflation isn't controlled by the Federal Reserve and some of these inflationary inputs around the world. If that persists, we potentially could have, and we could see a recession. Again, remember the inverted yield curve for the 2s, 10s? When the yield curve inverts, meaning the short-term interest rates are higher than the long-term interest rate, in this case it would be the short-term and the 2 and the higher the 10, that would precede basically 12 to 18 months later, basically says, hey, listen, that's an indication that a potential, not all the time, but it's a good factor to say, hey, listen, there is a recession on the horizon. Now, why would that be the case when earnings are growing? Well, we also want to make certain that pay attention to earnings, as earnings is what drives long-term the market price and market valuation. Think about this. If we own, which we do for our clients, dividend-paying companies, if the company stock price by market capitalization, meaning just the stock goes down in value on a daily basis, let's say what we're seeing, last couple of weeks or so, markets are going down, and you take that little individual company that's paying, let's say, a yield of 2%, and the more the company goes down, the higher the yield goes in terms of price valuation. That means that the yield's increasing. It doesn't mean it's actually increasing. It just means that the ratio of the dividend yield payout is higher now because the value of the company is down. So what happens? That attracts buyers in the marketplace and saying, hey, that 2% yield is now a 3% yield. That's an attractive valuation because you can't fake a dividend, right? It's part of the earnings of a company. It's part of the real cash flow. And corporations don't want to reduce or suspend dividends. In fact, it's the kiss of death. So ultimately, it's a safe bet to say, hey, listen, is that company making money, and are they paying out through way of dividends? And yes, and most are actually growing earnings, so are growing dividends and paying that to the shareholder. So it's a good way of saying, hey, listen, most important when we have market drawdowns, pay attention to earnings. Now, that doesn't mean that earnings can't come down and the future multiples are down. In fact, the long-term average right now for the S&P 500 for the future price to earnings ratio is 16.6, well below, just a little bit below the 16.9%. But remember, just a few short months ago, we were above 22%. So we're lower than the 10-year average, which means that the valuations right now are good. Well, we're getting a bounce in the market, Rob. Is this normal right now? Well, yeah, in a bear market, we do see some relief rallies. We could have more. We're not calling the bottom just yet, but we're getting close as we're seeing tremendous valuation valuations putting money and cash to work, like Warren Buffett has this last quarter. If you've been paying attention and following along, he's actually on a shopping spree right now because he sees tremendous value in the market. And we have cash for our clients. We're well balanced, well diversified, and we take opportunities in stride and redeploy when we see fit of great opportunities. That being said, when we have a rally like we've seen the last couple of days, which is a welcome relief, and that's called a bear market relief rally, we also then want to pay attention to, okay, well, what could stop this rally? Well, it's resistance, actually. From a technical perspective, the next key sort of markers we have to pay attention to in this rally is the S&P. S&P right now is at 4,065 as I film this right now in terms of the index. And we are looking at the 200-day moving average as sort of a top resistance. So as markets have a relief rally, they get up to in this case, the 43.31, and they could actually draw back down. And the QQQ, which is a proxy for the NASDAQ, we're right now at 304. And we could go up to 335 and then come back down. All the while, we'll put some money to work. Energy and utilities, industrials are still working rather nicely. So out of the 11 sectors of the S&P 500, there's always value and there's always opportunity. And not that everything works together at the same time, but essentially, you always want to keep your eye on the earnings. Earnings growth is there, and companies and corporations are strong and balance sheet strong. Now, what could happen later this year? Well, we have the midterm elections. In midterms, traditionally, if you look at a chart right now, the midterm election, let's say if you take all the midterm election years put together that we have with the data, it shows that you're basically just trading on basically a sideways until you get to the September-October basis. And really what happens is when you get closer to the midterm election, we have what's called certainty. Right now, you got a whole handful of uncertainty with geopolitical and political sort of events on the horizon right now. And what happens is, traditionally, historically speaking, if you look at the midterm time frames, just taking that out, extrapolating that data, you have a sideways market, potentially a retest of where we were earlier in terms of bottoms last week, maybe even a little bit lower. It could happen. And essentially that's in the summertime. So maybe as we get closer to August, September, we could see that retest. And then when we get closer past the election, the midterms, historically speaking, we're not predicting the future. No one really knows. But if you look at history as a guide, it really then shows that markets will start trending higher. And we've gotten through this bear market, sort of grinding our way through it day by day. But then again, there's always opportunity. That's where you make your money, is in bear markets. It's like no different than real estate. You always make your money when you buy, not when you sell. And essentially right now we're getting a tremendous valuations. We got corporations that are making, that have strong balance sheets, that are making earnings and growing their earnings. This is a great time to be looking for what's on sale for the next long-term investment strategy here. So that's what we're doing at Blanke Schein Wealth Management for you and all of our clients. Have a great day and take care.